Well, thanks again, and hello, everyone. Welcome to our weekly 20-minute webinar. I'm Jim McCormick, Global Head of Desk Strategy at NatWest Markets. Joining me again today are our co-heads of Global Economics, Michelle Girard and Ross Walker. And as far as today's agenda, Ross is going to discuss the outlook for next week's ever-important flash PMI data for the month of April. Also, the deluge of growth data that we're getting out of the UK. Michelle's going to talk about developments on the US economy this week, but also what the shape of a US recovery might look like. And then finally, I'll finish on 4 or 5 what I see as important market themes. We will have Q&A afterwards, so send us text anytime during the call with questions that you'd like us to focus on, or you can use the raise hand function during the Q&A. And with that, I'll hand it over to Ross.
Thanks, Jim. Yes, on Thursday we get the flash PMI surveys for the major economies. They took quite a knock in March, but we think they're going to fall significantly further in April, as the April survey will have been conducted entirely against the backdrop of the full lockdown, whereas the March surveys only partially captured that. The main takeaway is that we will see almost certainly these PMI indicators hitting new historic lows. In terms of US, Euro area, and UK indices, we would expect the composite measures, manufacturing and services, to be sort of languishing in the sort of mid-20s type territory. Bear in mind, a 50 reading is stagnation. So this is really very, very deep recessionary territory. We've noted before, we think this will be a temporary slowdown. And for the global composite, you've got some different moving parts here. China, of course, had an earlier entry into the coronavirus crisis, an earlier lockdown. But then on the other hand, economies like Japan, it was only this week that you saw the national emergency being declared. So the global index, the global composite PMI, we think will fall all the way to around 30, again, unprecedented levels. And what this may do, the positive from this, firstly, we think that April will probably be the base. This is the bedrock. And if we are to see some easing of lockdowns emerging at the end of this month and in May, you would expect to see some, if only a partial, but some improvement in the indices in May. And that may be important for market sentiment, because at least it gives a sense that we've turned the corner in this process, even if there is still lasting damage, and it will take some time to gauge that. In terms of other UK data to highlight, the UK, I think, is going to have its own US jobless claims moment, if you like. Next week, we'll get the claimant count measure of unemployment, and I think we're going to see a historically large rise, the sort of number that you might otherwise wonder if the decimal point was in the right place when you see the figure. Right? We're looking for something like a 440,000 increase in the claimant count. It's by no means straightforward forecasting this number, but we have got data for a parallel welfare benefit, universal credit. That surged by almost 1 million in the final 2 weeks of March. And although not everyone who is entitled to universal credit will fall onto the unemployment claimant count measure, a sizable number will. So we could see the UK unemployment rate next week jumping by at least a percentage point, and we would expect to see further sizable increases, maybe to around 7% or thereabouts later in the year. The only point to add here, right, is of course the UK's job retention scheme should tend to limit the numbers of unemployed. Nevertheless, there is a large labour market shock coming. One positive from this may be that over time, this starts to help rebalance the debate among policymakers in the country at large. You know, understandably, there is a priority on the public health angle at the moment, but at some point, the trade-off between public health considerations and the wider economy, I think is going to have to come to the fore. And I think as we get, you know, these quite frightening economic statistics over the next few months, that will be an important catalyst in that debate. But on that note, let me pass over to Michelle Girard, our US economist.
Thank you, Ross. Well, in the US, we had data on both the demand side and the supply side that underscored the impact of the hit to even Q1 growth from COVID-19, even considering the fact that activity was not fully disrupted until the final month of the quarter, arguably the final 2 weeks of the quarter. The impact is going to be pretty significant. It's showing itself pretty significantly in these March data. On the retail sales side, we saw a record 8.7% drop in spending. Outlays on discretionary categories like restaurants and apparel falling 25 to 50%. On the supply side, we saw industrial production in March contract 5.8%. That's the largest monthly decline since 1946. And we point this out because we all are well aware of the hit that the service sector is taking, whether it's airlines, hotels, restaurants. We know that the service sector is taking the brunt of the hit from the outbreak, but these IP data certainly confirm that the manufacturing sector has equally entered into a sharp contraction, and we'll expect to see that evidenced in the PMI data that Ross discussed next week. So in the wake of these horrific kind of numbers, as Ross mentioned, that we're seeing, we have taken down our Q1 GDP estimates reflecting this larger hit just from the 1 month. We now look for Q1 GDP to be down 4% annualized. We're sticking with our second quarter contraction forecast of 32% annualized, but the data for March underscore that the risk is clearly to the downside and by a wide margin. The numbers could be far, far worse than even what looked to be awfully bad numbers to begin with. Now, the good news is the market has largely taken these bad data in stride. I think that's in line with our own thinking, that the depth of the contraction in the first half of the year is not nearly as important as the timing and magnitude of the recovery that we see in the second half and beyond. So I want to just take a minute. There's still a lot of discussion around the shape of the recovery. Will it be a V, a U, an L, a W? And I just wanted to take a minute maybe to give a couple of thoughts on our views around each of those so-called letters. So Dave, can I ask you to post the slide on the screen? So the screen here shows that historically, most of the recoveries in the US have been V-shaped. That is that you basically saw a return to activity levels that existed before the downturn in about as much time or less time that you actually saw the economy in recession. Now, clearly the one exception is the global financial crisis, which is more of a U. The weakness, kind of gradually became more pronounced, and of course it ended up taking 10, 11 quarters before we saw activity return on a sustainable level to where it was before the crisis. So, that is historically how things have looked. The V or the U, I don't think either of those letters will define the current episode. The sheer stoppage of economic activity, the sudden halt, certainly prevents on the entering side of the recession any idea that this will be a U. The downturn is going to be very dramatic. On the exiting side, we all recognize it's going to be much slower to start the economy back up than it was to just shut the economy down. So that makes a kind of a V-shaped rebound on the back end, a steep ascent, also unlikely. So I think we can put aside the prospects of either a V or a U when we talk about the shape of the recovery. We do have other letters like an L. And here too, our own view is just the magnitude of the drop in the second quarter, if you will, in particular, where you basically halted 90% of activity. It just makes an L less likely. You can't keep the economy shut down to this level for an extended period of time. I also think it's worth noting that the unprecedented policy actions on both the fiscal and monetary side make an L less likely. The one letter that does worry me would be a W, where you reemerge only to fall back down, potentially because of a a second wave of the virus. Now, I actually assume that we will see some magnitude of a second wave in the fall, let's say. My assumption is, however, that we'll be far better prepared to deal with that we'll have the supplies, we'll have the hospital beds, we'll have the testing, all of which will help us to deal with the second wave such that we don't need to return to these drastic broad-based restrictions that we saw that led to this sharp contraction in the spring. So I don't think a W is a base case, although it's the one scenario other than our own that I am keeping mostly an eye on. In the end, then that leaves us with, as you can see on the screen, for the COVID recovery, a swoosh shaped, if you will. And we've been talking about this. You see the sharp contraction in the first half. You see a decent, rebound in the third quarters and more in the fourth. On balance, though, you only recoup about 60% of the first half decline by the end of 2020. And it isn't until the end of 2021, as we keep saying, that you actually see activity returning to pre-virus levels. So with that, I'll turn it back over to Jim.
Thanks, Michelle. Well, as always, I'm going to switch to a discussion of markets. And it was, to be fair, a quieter week than what we've seen by recent standards. But I still think there's some interesting trends and themes to talk about. So to start, we'll talk about risk assets again, which seem to be finishing the week on fairly strong footing at the moment. The S&P is now trading at the highest level since the beginning of March. And what's pretty clear is this, despite all the grim news on growth and earnings, the market is focusing on mainly the positives. And I think the most important positive continues to be the trends in the virus itself. As we've talked about on this call, in the past 2 weeks, we were seeing peaks in daily mortality rates across Europe and in the US at the moment. And I think more importantly, particularly this week, is we're starting to see some concrete discussions about how economies are going to be opened up. And I think that certainly is helping market sentiment. As I said last week, I think that global equities have probably gotten a little bit ahead of the underlying growth picture. If you look at our growth framework, purely from a growth perspective, the global MSCI could be another 10 to 20% lower than where it is today. But I think really the questions that matter most are one, what does the strength of the recovery look like? And judging from both what Ross and Michelle are saying, it's probably going to start next month, but it will probably be relatively slow. And two, do we see a second wave of the virus, and how do governments react to that? So I would stick to what I'm going to call a pretty low confidence negative view on risk assets from here. With that, I think there's 5 pretty interesting themes to think about with markets right now. And the first one is probably the most important one, which is it feels safe to say that sovereign risk in Italy and what that means for the future of the Euro project are very much back on the radar screen. It was a bad week for Italian assets and for most assets that are linked to Euro breakup risk. And I think on the topic of Euro stress, I'm just going to start by reiterating our base case, which is we think Italy is fine for now, and we feel that the market is kind of overplaying the underlying risks to the Euro project itself. On Italy specifically, in the short term, we just think the ECB's policy framework is just too big and too supportive to really fight right now. It's also quite unpredictable, so you're playing a difficult game and paying high carry to do it. I think longer term in Italy, it's really a question about the political situation both in the country and for the Euro area as a whole. And I'll just emphasize there that we are more positive than most on that. Away from the base case, I did update a framework we built a couple of years ago that we called the Eurozone stress matrix. If you want to see a copy of that, let us know. But my takeaway is if you genuinely think that Eurozone stress is going to pick up from here, there are some pretty good ways to hedge that risk. So one is through foreign exchange volatility. So Euro FX volatility is at very, very low levels compared to periods of stress in the past. And the other is, I suppose, other peripheral bond markets. So yes, Italy's under stress, but so far the stress in places like Spain and Portugal have been a lot less. Second theme for me is Asia, and I think that Asia is going to come out of this crisis looking relatively attractive. To start, the Asia recovery is already on its way. We saw that with the news overnight in China, where we got both the Q1 GDP numbers as well as the hard data for March. Quick story here is that the recovery is certainly slow, but it is manufacturing led, and it is happening. So we are looking at the beginning of a recovery in China. I think the second point here is that, very interestingly, exports in Asia have been holding up pretty well. So through March, the numbers have been better than expected. Now, I assume, as most do, that the numbers in April globally are going to be pretty terrible, but I do think the foundation for recovery in Asian manufacturing and exports looks pretty solid heading into the summer. And I guess the last point I'll make is the COVID-19 experience in Asia has clearly been better. Lower cases, significantly lower mortality rates, better testing, et cetera, et cetera, et cetera. The story has been relatively good. So I think from an investment perspective, Asia looks like a good, solid outperformer heading into second half of the year. Third theme is, I think there's something really interesting going on in emerging markets, one with very important implications for emerging market currencies. Now, normally during crisis periods, you tend to see a lot of emerging market currencies fall pretty sharply, and this forces central banks to eventually raise rates. Ultimately, those higher rates are what finally end up bringing investors back, and you see recovery in those currencies. Today's crisis is different. We're certainly seeing the weakness in the currencies, but we're not seeing the central bank rate hikes. As of the cut from the Philippines yesterday, we've now had 33 rate cuts in emerging markets already this year. And I think the way to look at this change is there's a good and a bad story to it. The good story to it is that emerging markets are evolving, that you're not seeing the same inflation pass through from weak currencies that you've had in the past. And I think that makes emerging markets an interesting investment proposition from a long-term point of view. The bad story is currencies don't have interest rates to force the recovery. So to really get emerging market currencies higher, you need a good growth outlook and you need a good policy response to this COVID-19 crisis. And for that, our emerging market teams this week talked about upside in things like Chile, Poland, Czech Republic. I'm going to add Korea as part of my positive Asia story. Two final themes here that I'll finish on. Firstly, as we expected on this call last week, we did get an OPEC deal, and it didn't help to boost oil prices. So WTI oil price is now trading this morning at a new cycle low. We don't see a whole lot of upside for oil prices, to be fair, until you really start to see a pickup in demand. And I'll throw my anecdote for the week into this call, which is the CEO of United Airlines, who basically said that in March of this year, you had the same number of passengers for the entire month that you would have had in one day in March of last year. Pretty much tells the story for what's going on with oil. And finally, we're in the very beginning of the U.S. earnings season. This week was mainly about banks. The numbers were pretty bad, and unsurprisingly, one of the big macro trends this week was significant underperformance of banks. I think, ironically, I'll finish that with a positive note, which is the big outperformer in equity this week is consumer discretionary stocks, which suggests that investors are starting to buy into the reopening of economies in Europe and the US. So with that, I'll open up to questions. Okay, so I've got a first question. It's actually a question that I think I was going to ask, which is, given this is for Ross, I think, given the renewed pressure that we're seeing on the continent, in Italy in particular, what does that mean in terms of the Brexit implementation and negotiations?
I think the short answer is it makes them more difficult, or at least it increases the the risks that we have a rushed, incomplete trade deal, because on the UK side, there is a political desire just to be seen to be getting a trade deal done and moving on, rather than focusing more on the content of that deal. So even if the crisis around Italy is related to the monetary union rather than EU membership and trade in the single market, it still tends to, from a UK perspective, I think, reinforce the argument that, oh, the sooner we get out of this the better. And equally, some of the proposed solutions, if part of the solution to the problems that Italy faces is more mutualization, fiscal union, bigger tax transfers, that also tends to reinforce UK Eurosceptic arguments that we need a more minimalist trade deal. So UK-EU talks resumed this week. Nothing of substance, but they have agreed a 3 rounds of negotiations ahead of the end of June point, where this key decision has to be made on the extension of the transition. So I think, as we said in last week's call, I think the risks of both an extension are rising, but also ultimately, because of the constrained time frame, risks of no deal are also going up as well, both at the expense of a deal.
Thanks, Ross. We have apparently a raised hand, so please ask your question.
The raised hand comes from Frank Krusch. Frank, please unmute your microphone and go ahead. It appears this may have been an accidentally raised hand. I'll hand back to you, Jim.
All right. A couple other questions that certainly I have. So Ross and I were talking about this earlier this week, and Michelle and I more recently. But there's all this focus on the shape of the recovery. We have all these different letters. I had the Wile E. Coyote shape in my head, but there is a nonlinear dynamic to this, that you do get a recovery if and only if you actually turn on the economy soon enough. And I guess this is for Ross and or Michelle. At what point does it become almost too late and we really need to start thinking about significant financial implications of being shut down?
Ross,
yeah. Well, there was an interesting survey a couple of weeks ago by the British Chambers of Commerce, and they essentially asked their members, what sort of cash balances do you typically have? How long can you ride out this sort of storm? And about 17% said, look, our cash reserves are literally the equivalent of 1 month's cash flow. So in other words, there will be a minority of UK companies, concentrated more in the SME sector probably, who after sort of 4 to 6 weeks start to run into certainly significant liquidity difficulties and quite possibly solvency difficulties. The survey also showed that over 60% of respondents said that they have about 3 months worth of cash reserves. So, as a first proxy, and given the lending support, the cash grants, the job retention scheme measures that the government has put in place, which will buy some time, you would think that we could get through a calendar quarter in full lockdown. Were that to extend to 2 quarters, I think then you start getting into serious difficulties, and you probably see at that point a wave of bankruptcies, more significant lasting damage to the economy, unemployment that is persistently higher. And hence, although we saw this week in the UK a 3-week extension of the lockdown, that will take us into early May. But really, I think at that point, there is then an expectation that we begin slowly, gradually to start lifting these restrictions. And as I say, I think as over the next month or so, as we start to get some truly horrendous, unprecedented economic data, the debate is going to rebalance. And hopefully with the coronavirus statistics improving as well in parallel, we can move to a position where we can start easing the lockdown and getting back to some sort of normality. But in short answer to your question, sort of 3 to 4 months should be manageable. I think once you get beyond that point, you are at real risk of getting to a cliff edge or a real tipping point.
I guess in the U.S., I would worry that it's a little bit on the shorter side of that. Some of the surveys that I've seen would suggest that for many of the small businesses that are being so hard hit, in particular, I mean, for a much larger proportion, it is more of a kind of a 1 to 2 month period of time. As you get past even 2 months, you shift from a so-called liquidity issue to a solvency issue. So, I think that this is what policymakers are very afraid of. And as Ross said, you've got, an incredible amount of actions taken to try to provide a bridge for businesses to get past this period of time. And I would expect that if in any way it looks like it's longer, you'll just see greater action. But I guess the one thing that I'm also cognizant on a related note is the idea that we're very much on board with the biggest hit is in April, and then you start to recover. But one of the things that will limit, I think, the recovery and as we look ahead to May and June is the potential. We've talked about it here in the U.S. We've seen it actually of sort of a second knock-on wave or knock-on effect. You initially see many small businesses shuttered as a result of the closures, but then that actually ripples through to other industries like the legal, like accountants, industries, professional services that provide support to a lot of those companies. And again, that leads to a second wave of sort of layoffs and declining activity as a result, even as things start to open back up. So, I think the way that this sort of rolls through, even if we don't hit that cliff edge, even getting past the kind of even in that 1 to 2 month window, there may be more damage to be felt as a result of what's happened than what we're seeing, than what we've just seen or had thought about.
Okay, thanks, Michelle. So I have a raised hand, but I have one question that I'm going to answer very, very quickly, which is really, the question is, what do you think is the Euro view based on the coronavirus and the fact that the pressures are mainly in Spain, Italy, and Germany? I think the question really becomes, do you believe in the stress you're seeing in Italy and the Eurozone, or do you think it's overdone? So again, I will go back to base case, which is we think the market's overplaying the risks around Italy. We think the market's overplaying the risks around a breakup of the Eurozone. As a result, our view is we do think the Euro will be higher by the end of this year. But I will say it doesn't come without risks. I think the market is going to test the Euro group, the Euro Council, the Eurozone, and until we feel confident they're going to pass that test, I think the risks are pretty double-sided. We do have a raised hand, so we can answer that question now.
We have a raised hand indeed from Joaquin Arbus. Joaquin, please go ahead.
Hi, can you hear me?
Yep.
Yeah, my question is, are we factoring in the different potential scenarios in terms of what's the immunity of the people who have actually been infected? What I have in mind is if people get sort of immune for life to COVID, to a great extent, this can be a quicker recovery. But if this can come back and there is a limited period in which people are immune, then the recovery and the confinement can linger way, way longer than we expect. Are we factoring that in? Thank you.
Yeah, so I guess we're all amateur virologists at this point. So I'm sure each of us has a different answer. I think Michelle in some ways answered it in terms of describing the shape of the recovery, which is that the understanding of the COVID virus and the response to the COVID virus is not a constant. That over time, technology is improving. Over time, our understanding of how to deal with it in terms of testing and contact tracing is getting better. And so, our assumption is that this very blunt shutting down of economies is certainly not optimal, and I think countries will try hard not to repeat them. And so this should be the worst in terms of the economic shock. But clearly, if this isn't going away, we have to keep going through rolling more targeted shutdowns. It means any recovery is going to be very shallow. And what I would say, and I've said this many times, is that there is a bunch of positive tail risks as well that we just can't put a number on, including a story overnight about an antiviral test, which looks to be moving in a fairly positive direction. I think there's been some pushback on that, but we have to recognize that with each day that we do these blunt economic shutdowns, we learn more about how to go forward with it. So hopefully that answers the question. I don't know if Michelle or Ross might have anything to add.
No.
Okay, so I think that is the questions for today. Hopefully you're enjoying this format. This is the third week that we've done it. We're certainly enjoying it and look forward to hearing from you this time next week. Thanks again.